Tim, let's just start with an easy one.
Good morning, Dom.
I think it's easy. Is the low in?
You can't make me answer that question this early in the morning. Look, here's what I would like to respond. The response in terms of fiscal and monetary from not only the Fed but around the world. China last night cut their reverse repo to $2 billion and pumped another $7.5 billion into their market. It's been unprecedented, and it's been swift, and the movement here has been extraordinary. That is what investors should take some heart in. The fact that, again, look at the companies that have reported some uptick in China. Listen to what Nike had to say. Listen to Starbucks. Listen to those companies that have seen at least the beginning of the other side. And again, we shouldn't get too caught up in China data at this point, but the fact that the PMI and services data that came out just a couple hours ago was well into expansion and shows a sharp rebound from the lows should give some light into the sequencing that we're going to follow on this health crisis. It doesn't mean we know where we're going to be on the other side of a labor market in the United States, and we know how painful this is going to be. Markets have recovered dramatically. In my view, the 20% we've done so far probably runs into a little bit of headroom here around 2750 on the S&P. And what I would take some solace in if I'm an investor here is I'm not so sure that we have to have this big double dip return to set new lows. So I'd rather answer the question that way. I'm not sure whether we've found necessarily that bottom, but I will say that I think the economic response has been very encouraging.
Hey, Tim, maybe anecdotal consensus is better in this case here, because basically just about everybody I've talked to with regard to the trader or institutional investor side of things say that they expect that we could see more downside volatility. That seems to me like everybody thinks one thing. Maybe that's a positive sign. The contrarian me says this is a good thing.
Right. So the wall of worry that we've seen so many times over the last year and a half, where we've had headwinds from, we know what they were. And the market seemed to respond almost as if those things were not only headwinds, but they were actually tailwinds. I do think when you see the response that we've seen in the market and the expectations of maybe a March 2009 revisit, that's going to be extraordinary, I think, to duplicate. I also think that the sequencing, as we talked about here, is going to be very different. So, yes, certainly extreme pessimism. Some of the activity that we saw in the market 2 weeks ago truly were redemptions and liquidations of an epic proportion. Hedge funds going out of business, asset-backed managers needing to meet fund redemptions in less than liquid products. But the fact that the Fed has been in here buying everything, the fact that you've seen a fiscal response that also, now Speaker Pelosi is talking about the next round, this is giving the market what it typically would need. And to be clear, policymakers are targeting the market as much as they're targeting anything else.
All right, just 10 seconds left here. What's your biggest worry?
My concern is that at some point we are going to see, we came into this at peak labor. The payroll numbers on Friday are very important. Jobless claims on Thursday are very important. I think there's going to be a lot of pain across this country, and we're not going to know overnight.